restricted funds, and institutional funds. When you invest your funds at the Jewish Community Foundation, you are partnering with a trusted resource in our community, and we carefully steward your philanthropic dollars. We also are the lead agency for the Life and Legacy program here in our community. And through that program, we are building and sustaining the Jewish organizations in our local community. I'd like to show you the agenda for this evening's program. As you can see, I'm welcoming you all. We will then have remarks by Harvey Fram. Harvey Fram is the Vice President of Investment at the Jewish Community Foundation of Greater Mercer. He is a trustee on the foundation board, and he currently runs his own investment management firm for the past 10 years, and previously a Morningstar 4-star mutual fund manager. Harvey will talk about the investment philosophy, investment implementation, and investment options under consideration. We will then have a presentation by Dan Voss. Dan is a senior investment consultant at Mercer Investment. Prior to the recent transition to Mercer, Dan was with Vanguard since 2011. He oversees endowment and foundation portfolios, assisting institutional clients like the Jewish Community Foundation with asset allocation, portfolio design, and investment policy. Previously, Dan was an investment analyst. He holds multiple financial industry regulatory licenses and is a CFA charter holder and chartered alternative investment analyst. There will be an opportunity for our audience to ask questions. Please enter your question in the chat box, and when the presentation is over, we will manage the questions. So thank you again all for being here. And Harvey, it's time for your Oh, one last thing. I want to introduce the names of the members of our investment committee. As I mentioned, Harvey Fram, Jeff Feinstein, Joyce Kalstein, Michael Manning, Jerry Newman, Mike Gasol, Scott Schaefer, Martin Schwartz, and Alex Simonovsky. Harvey, please.
Thanks, Linda. So let me just ask, do I have control of the screen? Do people see my mouse as it moves around?
I have control of the screen.
Okay, well, okay. So welcome everybody. So I just wanted to give a brief introduction to how we manage the portfolio. So as you probably are aware, we have one investment portfolio, which is a balanced portfolio, and the basic classic mix of stocks and bonds. And the reason why people put stocks and bonds together is that historically they've been very uncorrelated, and that gives you the benefits of diversification. So we start out whoops. Yeah, there we go. Okay, so we start out with a portfolio that's made up of low-cost index funds that represents each of these two main classes. However, we will add actively managed funds where appropriate. And right now we do have one of those in the portfolio. So let's moving along to the next page. Do I have control? Okay, I guess I do now. So as Linda said, we work with Mercer Consulting that used to be a division within Vanguard. And when we started working with Mercer, they give us the broad framework for managing the portfolio. So that means they said to us, the best practice is to have a mixture of stocks and bonds, and you can choose the portfolio, you can choose that number of the mixture, but we want to make sure that you have that mix. And importantly, what Mercer does for us is they help us keep our target allocation in line, because we have a lot of funds coming in and out, a lot of cash flows coming in and out of the portfolio, and it can be a difficult task to keep us at our target allocation. So what the investment committee does is we choose the target allocation. So as I said, Vanguard said, choose something in the range of 60-40 or 70-30, and we ended up choosing 65-35 right now. That means 65% equities and 35% bonds. And for us, for most people that are professional investment managers, the equities are the All Country World Index, which is the main, that's taken over as the main index for equities in the world. And the bonds are represented by the Bloomberg Aggregate Bond Market Index. So as I say, all of the, the investment committee chooses funds. Vanguard, when Dan and his group managed us, they were at Vanguard, obviously a big proponent of index funds. So our point of departure was to start out with index funds, and then if we saw something interesting, then we would add an actively managed fund to the mix. And as I said, right now we do have one actively managed fund in the mix. Also, what we as investment committee do is we'll rebalance the portfolio. That means if a big event like COVID happens that causes the portfolio to go out of whack from our 65-35 target, then we would buy stocks and sell bonds if necessary, or vice versa. Actually, so moving on to the next page. So maybe big news for some people is under serious consideration. As I said, our portfolio right now is that moderate allocation mix of stocks and bonds, but we know that there's been demand for other options, and we are seriously considering, and hopefully we'll be able to implement this shortly, two other options. One is an aggressive allocation, basically all equities. So you, for example, if you're Avadona as Via Fund, you can choose all equities instead of that moderate allocation, and maybe you want to do that because historically equities have done a lot better than bonds. And the equities within that portfolio will exactly match the equity allocation of our moderate allocation strategy, but it will only be the equity piece. The second option that we're considering is the conservative allocation option, which is basically designed not to lose money. So that instead of investing in bonds or the bond component of what we manage for the moderate allocation, that instead will invest in short-term investments, which right now are yielding recent highs in yields in the order of 5%. So basically short-term money market funds, which might be, or investment grade money market funds or CDs or even treasury, short-term treasury bonds. So with that, let me hand it over to Dan.
Great. Great. Thank you, Harvey. And thank you very much, Linda, as well, for the introduction and for the opening comments. Bear with me for one moment here as I share my screen, and I'll start going through my presentation. Now, as it's been mentioned, my name is Dan Voss. I'm a senior investment consultant. I work for Mercer Investments, LLC. Prior to March of this year, I worked at Vanguard for about 13 years. And I'm very happy to be the primary point of contact for your team at Vanguard here. I'm quickly going through what the agenda is for my portion of the meeting, and I'm planning to take about 25 minutes or so and leave some time for questions at the end. So you see the welcome to Mercer being the first agenda item. Mercer is a global consulting firm, and it has the largest global outsourced chief investment officer, and I'll get into that in a second, what that means in the world. And so because of that, there's a ton of brand recognition, ton of name power, but not everyone's familiar with it. I understand that. So I have some slides that are going to go into the background of what Mercer is and what makes Mercer special. The portfolio review, second section here. How has your portfolio performed? How is it currently positioned? And without giving away the whole story, it's a good news story. Markets have been great and they've been kind to your portfolio. And then finally, we'll finish with our thoughts on the markets and the global economy going forward. Starting with the Welcome to Mercer section. So what you're looking at here is your team at Vanguard. This is your dedicated team. This team is aligned with your organization. And so we work with Harvey and the investment committee. We work with Linda and the administrative staff at Jewish Community Foundation of Greater Mercer. My face, of course, you should recognize me there on the left. I am the senior investment consultant. So I am your primary contact. My job is to meet with the investment committee most times four times per year, also answer any sort of ad hoc questions or join ad hoc meetings as they come up. Of course, things like the investment summit tonight, I'm also more than happy to be presenting to all of you today. You see I've been working in investments for about 13 years now, working with nonprofits specifically for the last 8 years or so. To the right of me, you see in the middle, Lean Lay is the senior investment consultant. She's more of the background investment analyst that supports your organization. And what her work is you see that she does a lot of the research and analysis that goes into your portfolio construction. She also assists with trades as your portfolio and as you are generous enough to gift money to the organization. That money needs to come in to become invested, and Lean and her team help to support that. You can see the alphabet next to her name there. Very credentialed, very tenured, and a superstar for our team here. And then finally, last, certainly not least, Chris Whitney is on the right. He's a client service analyst. He assists with brokerage questions as an example. If you gift shares of stock to the community foundation, that goes through a brokerage account that then needs to be liquidated and transferred to the investment portfolio, just as one example. And Chris is the right person to connect with for the administrative staff to assist there. So Chris is through email or through phone calls speaking with the staff pretty much every week, and again, an invaluable part of our team here. This is the team that has come over from Vanguard. So you see here now we're talking about slides from Mercer. Mercer made the decision to acquire Vanguard Institutional Advisory Services, our department that I worked in for 8 years or so. And this was a recent decision, and the deal was closed on March 15th of this year. But the entire team that you saw on the last page, we all came over. About 118 or so staff are now Mercer employees that were previously Vanguard employees. So I consider it same team, different jersey. However, there are some benefits, some big benefits to now being Mercer clients. And I'm going to start with the size being an advantage. I mentioned earlier that Mercer is the largest global outsourced chief investment officer. And that term OCIO, or outsourced chief investment officer, what that means is it's providing discretionary advice to nonprofit clients to help them meet their goals. And so Mercer, the largest OCIO in the world, and what that scale allows is for it allows them to negotiate fees, attract talent, and have a massive research team so we can bring really our best idea to Harvey and the investment committee. The second bullet point there, specialized expertise. Mercer has done this for a very long time. The team that was acquired from Vanguard has done this for a very long time. So if a question comes up, it's likely we've heard it before. We have plenty of clients that are similar. We know every client is unique. We try to get all that information together to help, again, meet your goals. And then finally, at the bottom, trusted partner. Clients told us they have confidence in us. So it's not just taking my word for it. It's that the clients, they've expressed their satisfaction through surveys and also through the retentions. And I'm happy to report a very, very high percentage of our clients from the Vanguard business model came along with us for the journey to become Mercer clients. Now, question, of course, there's some change, acquisition. So what can we expect going forward? And I've had this conversation with the committee, with Linda, with the staff. Here's what won't change. And again, this is if you are satisfied with the way things are today. And that's the conversations, of course, we have every quarter with the team. Your team, I've mentioned that a few times, your team is still your team. Your scope of service. So quarterly committee meetings, fund holder meetings, that's not changing. The performance reporting that we do, all the services that we do for the Jewish Community Foundation of Greater Mercer, that's not going away. We're still going to do that. The investment approach, Harvey spoke a bit about the investment approach. We take a very diversified approach. We keep costs low where we can. investing is counterintuitive to maybe buying a car, right? If you buy a car, if you spend the most amount of money, you're probably going to get the fastest car. Well, with investments, oftentimes, if you spend the least amount of money, then you have the best returns. You keep more of that in your pocket. So those tenets of investing, of staying diversified, staying disciplined, and keeping your focus on the long term for long-term investors, that's in our DNA, and that certainly came with us to Mercer. And Mercer was doing that, of course, before we arrived. And then finally, the advisory fee schedule, new company acquisition. Does that mean we're paying more in fees? The answer is no. Your advisory fee schedule transferred over from Mercer from Vanguard over to Mercer. Now on the right, not going to go through each of these, but this is just to say that Mercer does have capabilities that I meet with the committee to discuss, and excited to have more tools in the toolkit to hopefully help create a portfolio, continue honing a portfolio that meets your goals going forward. Now, this is the last slide that I'm going to review for the Mercer conversation before I get into your portfolio specifically. And what this is, you see a flywheel here. All of it starts with the objectives and the constraints of the not-for-profit, the client, of you, right? So every not-for-profit is different. We understand that. There are a lot of commonalities between different long-term investors. The fact that there are no taxes being paid, again, that ability to keep a focus on the long time horizon. But meeting with the committee on a regular basis, understanding what makes you tick, what are the risk tolerances, trying to gauge that. That's my job to do that. Once we figure out the objectives and the constraints, what are we looking to do? What is our target, and what can't we do? Then we move on to the strategic asset allocation. And what that means is, what's your mix of stocks and bonds? Harvey mentioned between 60-40 to 70-30. Of course, with clients, we can go above that or below that. Currently, your Jewish Community Foundation target allocation is 65-35, 65% stocks, 35% bonds. Our research has concluded, and we're not alone, plenty of research has backed this up, that 90% of the return variability in a portfolio is determined by that mix of stocks to bonds. So you pick that mix of stocks to bonds. There's going to be fluctuations based on what you do within those buckets. But again, a very big part of it is getting that asset allocation right. So we're continually revisiting it to make sure that it still meets your needs. This next section here is the outlook. So overlay the market outlook in the intermediate term. So it's not a set it and forget it portfolio. We don't say 65-35 sounds great, we'll see you next year. No, we're continuing to reevaluate and make sure that our lead recommendations are still our best thinking. And an example of this, and meeting with the committee again on a regular basis, we're constantly having conversations about tweaks that we can make to the portfolio to really help fit your needs a little bit better, or to kind of accommodate for unique preferences within the organization. An example, there was a concern about inflation in the portfolio a few years ago. Speaking with Harvey and the group, those concerns were voiced to me, and there was concern about unexpected inflation. So not the inflation that we think's coming, but it's the inflation that you should be a little bit more scared of, right? That you have no idea it's going to come and then it hits you. Based on the conversation that was brought up by Harvey and the group, they wanted to add an unexpected inflation hedge to the portfolio. We were able to accommodate that and change the portfolio. We tweaked it to add a sliver of an allocation that is expected to do well during periods of unexpected inflation. And frankly, the trade worked out well. It ended up being a very good investment for the time frame that it was invested. We since have unwound that position. But again, just one example of the way that we're kind of looking and reading the tea leaves of what's going on in the global economy and the markets, and is there something that can be done based on something that's unique or rare that's occurring in the markets. And then implementation here, once we figure out the mix of stocks to bonds, international to domestic, it doesn't stop there. We need to figure out who's going to actually manage those investments. So my team and I, we're not buying and selling stocks within the mutual funds on a daily basis. We don't get paid to do that. We get paid to meet with you and the committee, but we have professional fund managers that are for index funds. They're buying all of stocks and bonds and tracking their mandate benchmarks to make sure that they are not tracking far off at all, tracking very closely to those benchmarks. And for the case of the active fund in your portfolio, we pay world-class managers to try to beat the benchmark. And I'm happy to say that the fund that we currently have in your portfolio has done a very good job versus its benchmark since we've added it. And then finally, monitoring it. Again, not setting it and forgetting it here. We have a daily vision to the portfolio. Trades come in all the time in terms of contributions and withdrawals. we are able to constantly rebalance you back to that target allocation. We also have guardrails in place where at 65-35, if that equity creeps up to 70%, we'll go ahead and rebalance at quarter end. That's a contractual obligation. If it falls down to 60%, we'll also go ahead and rebalance you back to your target allocation. The reason for that, it might make a little bit more sense on the upside. Well, if stocks are running too hot, if stocks go up to 70% from 65%, well, we want to take a little bit of risk off the table there. We think that your portfolio makes sense for 65-35. We don't want it to be a permanent 70-30 portfolio unless we strategically make that change. Well, it's less intuitive, but the downside, there's also a risk. If stocks are doing poorly and they fall down to 60% of the portfolio, well, that different kind of risk is the risk that you are not going to be able to meet your long-term goals. So again, we want to get you back to that target allocation, possibly taking advantage of maybe a dislocation in the market. Stocks maybe shouldn't be down to the extent that they are. Stocks have always rebounded ever since we started investing with stocks, right? And so just again, one example of the way that we think about monitoring your portfolio and keeping our eyes on it. Let's skip this slide here. So now this is your specific, the Jewish Community Foundation, the Greater Mercer's portfolio. This column right here, your current allocation, and the rightmost column is your target allocation. Your portfolio has a lot of cash flows with fund holders setting in money and with withdrawals as well, of course, which are used to rebalance the portfolio. It's not a surprise that you're sticking pretty close to that target allocation. So as of end of March, your equity allocation, 65.8% of that portfolio is invested or in equities, versus that 65% target. So I told you 70% is our trigger for rebalancing at quarter end. Of course, we're not close to that at this time. Within equities, we're investing 39.5% of the total portfolio in US equities. So the entire US stock market, large cap, mid cap, small cap stocks, growth value, all the companies you know and love that you can buy on the New York Stock Exchange, they are in your portfolio. International equities is 26.3% of the entire portfolio. Same concept, of course, may not be as familiar with all of these stocks. I think there's 8,000 or so of them, but we are using International Stock Index to capture the entire outside of the US stock market, emerging markets and developed markets. This is also the sub-asset allocation, international stocks, where we do take advantage of some actively managed mutual fund exposure. Because we do believe that outside of the U.S. there might be a little bit more of the ability to beat the markets, as information is not as readily available as it would be for U.S. stock market investors in the U.S. And then fixed income, 34.2%. Of course, if stocks are overweight, that means bonds are underweight versus your target of 35% here. Fixed income, we don't expect it to drive your portfolio returns. That's not why we have it in the portfolio. We have fixed income in the portfolio for that rainy day, for the lack of correlation, as Harvey alluded to earlier, or explicitly said earlier. When stocks go down, more often than not, bonds are going up. Think back to 2008, think back to March of 2020. We want the diversification in there. We want stocks to, again, when stocks are doing poorly, more often than not, bonds are doing well, and that's why we have them in the portfolio, so that the entire portfolio isn't going down at 20% during a bear market. Now, finally, let's get to your returns. Finally, from a portfolio standpoint, I should say, your portfolio performance. This is through March 31st. This first line that you're looking at here is your client portfolio, or your portfolio, I should say, gross of advisory fees, meaning that there is an advisory fee schedule that is paid to Vanguard. This number right here does include the expense ratios of the mutual funds, because you can't invest in anything in stocks, bonds, mutual funds, ETFs without paying some sort of fee, right? Somebody has to buy and sell those stocks and bonds. So this is net of the expenses of the funds, but gross of the advisory fees paid to Vanguard. This middle row here, this is net of everything. So this is your all-in return that you're getting from your portfolio. Again, this is net of the advisory fees and the expenses, and this is a policy benchmark that's designed to capture that 65% stock with international diversification, 35% bond target allocation. So we want to see, how has your portfolio performed against a paper benchmark? Paper meaning it's not real, we're tracking it, and there's no expenses associated with it. And the good news is, if you look over the last 1 year, gross of advisory fees at 15.94%, you are beating that paper benchmark. After you net out the advisory fees, you're only trailing that paper benchmark by 9 basis points. So Two things to call out on an absolute basis. Absolute returns, fantastic, right? 15.5% returns over a 1 year period. It's phenomenal. We certainly do not expect to get that every year going forward. That's not something that happens very often. And we know that 2022 was a very challenging year for stocks and bonds. And so we are coming off of somewhat of a market bottom. But when 15.5% returns occur, it's also easy to miss them, right? And so part of keeping that long-term time horizon and not trying to time the market, staying invested, is the phrase is time in the markets is better than timing the markets. And so this is a testament to the the collaboration with Harvey and the committee and Mercer now and me is making sure that we resist any sort of behavioral biases to sell out at the wrong time or buy in at the wrong time. Again, very strong returns over the last year. I'll go to this column now. You've been invested with Vanguard and now Mercer going back to the middle of 2020. I've been your primary contact this entire time. So looking back almost 4 years with plenty of ups and downs, and as over the last 4 years, I don't think I have to tell anyone in this virtual room about the volatile market and economic and global environment that we've been in. But you see the annualized return. So this is per year on an annualized average basis, net of all fees, 7.56% return versus that policy benchmark at 7.41%. So what this is telling me is that over the last almost 4 years, on an annualized basis, your portfolio has not only been able to make up for the advisory fees that you paid to Vanguard, you're now paying to Mercer, not only made up for the fees that come with the expenses of the funds themselves, but you're also actually outperforming all of that by about 15 basis points. So we don't expect significant outperformance, just like we wouldn't expect significant underperformance because your portfolio is so well diversified. But very happy to see that there's been a lot of success over the last 4 years, and we certainly hope that we know that we have the structure in place to continue success going forward. We know that not every environment or every period is going to be very, very great with the stock market or the bond market, but we feel very strongly that the teamwork, the collaboration, the approach that Vanguard and Mercer have, will help you continue to meet those goals that you have.
Dan, somehow you went off. Can you please check your you went on mute?
Can you hear me now?
Yes, thank you. Sorry, everyone, for the technical
I
difficulty.
apologize for that. My headphones just stopped on me. I'm going to go ahead and continue sharing my screen just as I was getting to the good part, right? You see here the 2023 in review. So what this is showing you is how stocks and bonds, stocks being in this blue line here towards the top, bonds being in this, I'll call it a greenish line, maybe seafoam line at the bottom. And this is global stocks and bonds. How do they perform in the calendar year 2023? And the reason I show you this, I don't expect you to read each of these individual bubbles, but there were plenty of events that occurred in 2023. As an investor, we want to put our blinders on and continue focusing on what we can focus on, what we can control, and keeping that long-term perspective. You see, as an example, I'll call out beginning March or so of that year, Silicon Valley Bank. You probably are all familiar with Sam Bankman-Fried, the issues that have occurred with assets being taken or stolen. And at the time, Silicon Valley Bank went under, other banks were going under. There was a lot of uncertainty. We stayed invested. And of course, we rebounded from that just like we always have. In the middle of the year, Fitch downgraded US government debt. Well, that didn't feel good as a US citizen to have our debt be downgraded by a global rating service. And so what does that mean for the portfolio? Well, we know that over the long term, interest rates and and valuations of stocks with the price that you're paying for it. That's what really drives markets over the long term, not short term volatility. And so again, it's keeping that focus on the long term keeping that focus on the long term, which again does tend to lead to long term positive results. All right, now we're going to get into the outlook section. I probably have about 5 minutes or so left. The global economy, you see the headline here, we expect it to remain resilient. Now, I will say that we have changed our forecast or kind of adjusted our forecast over the last year or so, initially forecasting a recession and then kind of backing off a little bit on that. It does seem like at this point, there is a lot of blue sky ahead that we may be able to avoid a recession in the United States. Now, reasons for that, the robust household balance sheet. So most workers' wages, they're going up more quickly than the prices of food and gasoline are going up. Yes, we had inflation for a while, it was very high, but at this point, real or inflation adjusted wage growth is positive. These next two bars, easing financial conditions and loosening monetary policy. So the Federal Reserve, they meet maybe 7 times per year or so, and they're in charge of the borrowing rate in the United States. They decide, should it be expensive to borrow money or should it be cheap to borrow money? And that decision bleeds all the way down to you buying a new car with an auto loan or credit card debt, mortgages, all of that starts at the top with the Federal Reserve. Well, we expect, or the economy expects, loosening monetary policy, which will be then easing the financial conditions, meaning that credit cards or companies are able to borrow money more easily, continue to reinvest in research and development, and hopefully boost profits for holders. We would expect the rate cuts to begin happening this year at some point. Although frankly, as more and more economic indicators come out, it does seem possible, and at some point it may seem likely that rate cuts may not happen until next year if inflation doesn't get down to where the Federal Reserve wants it to. Now, I say that declining inflation this year, for the most part, we have seen declining inflation. So inflation was very high a year or so ago. We know that. And we know why, for the most part, right? A lot of stimulus money was put in people's pockets during the COVID-19 crisis. Oil prices, due to wars overseas, were skyrocketing. And supply and demand mismatches with organizations, operations overseas, as some places had to shut down with again the COVID crisis. Well, that's starting to cool down. Now, it's not where we want it to be. It's not where the Federal Reserve wants it to be, but declining inflation has proven to be a good sign. And then cooling labor markets. Now, cooling labor markets might sound like a good thing. What that really means is that labor markets, the unemployment number is creeping up a little bit. Now, that may be a good thing because for the economy, I should say, because unemployment being too low means that companies need to pay more and more out of pocket to continue attracting talent. If a talented individual has 10 competitive offers on the table, you have to overpay to get them, right? Well, that does lead to inflation in the economy. And so with unemployment getting to a little bit of a healthier level where it is today, that should help to, again, cool down the economy from overheating. And we're not expecting the kind of inflation that we've historically experienced during painful recessions like 2008. Now, all of this to say, we have portfolios set up, and our portfolio principles are designed to really take advantage or to safeguard assets and to hopefully add some value during all economic environments. So calling out inflation for one. Now, I told you before the scenario about us adding a hedge for unexpected inflation during a few years ago when the committee was expecting what was unexpected, and they were correct about that. However, long-term inflation, we believe that stocks are the best hedge against long-term inflation. We know that over long periods of time, inflation goes up and down. So do stocks, but stocks have gone up more often than inflation has, and they've been higher more often than inflation. So we do have the portfolio set up to really, again, be an all-weather portfolio. Now, moving forward, skipping some of these slides, this will be the last slide that I show you, and then I'm happy to answer any questions that they've been asked. If they haven't, feel free to chat them now if you have any that come to mind. These are 10-year, and I want to be very careful about or specific to what you're looking at here. This is a 10-year forecast. So we're looking at 10-year annualized return numbers, and these are median expectations over that last 10 years, meaning that we could give you a 25th to 75th percentile for what we think stocks and bonds might do over the next 10 years. This is just looking at the very middle, that median forecast annualized over the next 10 years. We're comparing Mercer, this column on the left, to Vanguard on the right. And I'll tell you why that is after I finish going through some of these numbers. So starting US all cap equity, this is the entire US stock market. We know how great the stock market has been for a while. That gravy train can't last forever, unfortunately. I wish it could. We expect lower returns going forward. 5.5% is our median annualized expectation over the next 10 years for US stocks. Still positive. 5.5% is definitely better than zero, but it's not the 10% returns that we've come to average since the 1920s. Below that, you see international stocks. International stocks at 6.8%, so 1.3% per year better is our forecast for international stocks versus US stocks. That is because international stocks, or primarily because I should say, international stocks have really underperformed significantly versus the US going back to 2000, a decade plus now. And the starting valuation, that price to earning, is the number one input for our forward-looking modeling. So because of that, we are, and amongst other reasons that are a little bit technical, we expect international stocks to outperform going forward. Emerging markets as well. That second one was just the developed markets. Remember, you do have emerging market exposure, and we're expecting emerging market at 7.6%. So emerging market, I think Brazil, India, China, South Africa. What this all means, you roll all these stocks up, All Country World Index. Harvey mentioned that All Country World Index is the global, it's kind of the gold, it's kind of the, the premier benchmark for global stocks. MSCI's All Country World Index. Our global stock forecast combines all these to equal 6.1% at the median. You combine that with US aggregate fixed income, that FI is fixed income. So what do we expect out of US bonds going forward? About 4.5%. And so what that means is for a portfolio like yours, we're expecting returns of roughly 5.5% to maybe to 6% at the median over the next 10 years on an annualized basis. The reason why I said we'll talk about the Vanguard numbers as well is, you have been a client of Vanguard for 3+ years, and we want to show you here how Vanguard's thought leadership on asset class returns going forward, not too different from Mercer's. So you see some of the differences here on the right. Mercer is a little bit more optimistic about US stocks than Vanguard was. Mercer is a little bit less optimistic about international stocks than Vanguard was. And what that averages out to be, that All Country World Index, Mercer is just 0.2% more optimistic over the next 10 years for global stocks than Vanguard is. So very small difference there. Again, a lot of those inputs that Vanguard and Mercer are using are the same. I think neither firm is really going out on a limb versus consensus assumptions from the industry at Broad or at Mass here. And bottom line, we believe you're going to have healthy returns going forward. It's not going to happen every year. Certainly not going to happen every day or every month. But we believe you stay invested over the long term, that you will be rewarded for it. Risk does come with reward. It just typically takes patience at times. And we believe that we have the right approach in partnership with Harvey, with the committee, with Linda, with the entire team to really help you meet your philanthropic goals. So that's it for my prepared remarks. I'm happy to address any questions that have come up in the chat. I'm not able to see the chat at this point.
So thank you, Dan. We really appreciate what you've shared with us. So the first question that we have is there any historical data from prior, we're moving into an election year. Is there any historical data that speaks to how we should be investing in an election year?
Yes. So thanks for the question. It's not one that I didn't expect. Obviously, this is as we get closer and closer to the end of the year, it's going to become more and more polarizing, and it's a logical question. The answer is maybe not the one that everybody wants to hear, but our research has shown that there has not been a statistically significant difference whether it is an election year versus a non-election year, or whether it is a Democrat who wins versus a Republican, incumbent or non-incumbent. This year feels different. Every election feels different, right? Think back 4 years ago and how the stock market has done since then. That was certainly an interesting election. 8 years ago was certainly an interesting election. And so that is to say that that all will bring in some short-term volatility. Wouldn't expect to see, or would be surprised to see some volatility in the markets around election time. But over that long term, it's what stocks are driven by the price and the earnings. Bonds are driven by interest rates. And we're not going to time elections. I think it would be, we don't know how to. We don't think that it's that you can do that and continually add value without at some point taking a little bit of guesswork there. And so we're going to continue investing with the approach that we have. Of course, changing things, at the margins when economic, macro environments, change. Again, the unexpected inflation comment from earlier.
Okay, thank you. That was a terrific answer. This question is really a little bit for Harvey, I think. Will the future investment strategy vary as mentioned in the introduction? I think the person is asking about the options between different investment pools and how that will be managed, and will it be available to donor advised funds and to restricted funds? So Harvey, do you want to take that? You want me to help you with that?
Sure. So basically, the default option would still be the moderate allocation option, the mix of stocks and bonds. But for those who want a more aggressive portfolio, there will be that option. There might be a minimum, and there certainly will be limits to how often you probably can't change your allocation more than once a year, because there is an overhead, with our back office system in doing that. But I would foresee that certainly if somebody in a donor advised funds wanted their allocation to be one of those two, then they can do that, and that would be okay, subject to a certain minimum dollars invested. Linda, do you want to add anything to
Yeah,
that?
so what I want to say is that we will probably be rolling this out in the late spring or summer, and we will be sending to all of the fund holders, both custodial fund holders. The only funds this will not impact will be funds that were left by large funds that are solely bequest funds. Because they were owned by the foundation, and they were left in a certain way. But if you are, for example, a synagogue with a custodial fund, or an individual with a donor advised fund, and we're talking at this point in time of a minimum balance of $50,000, you would have the option to invest in more than one fund. And as Harvey said, it will be there will be a time of year when you can make your choices, and then it will be for 12 months. And at the end of 12 months, if you wanted to change it, you could do that as well. But everyone also, of course, has the option of remaining in the moderate fund that we currently have all of our investments in. Thank you, Harvey, for that. The next question is, I think, for Dan again. Dan, the question is about the Fed. The Fed thought that there was going to be more inflation, then it didn't turn out to be as much inflation. And so, I know you don't have a crystal ball, but if you are thinking about some of the decisions that the Fed will be making in the next few months, where do you think they're going?
Yeah. So thank you for the question. Right, the crystal ball would be perfect here. Although I think we might have to increase the fee if there is a crystal ball in my office. But we believe that the Fed is going to lower rates, but but they have to be very careful to be deliberate about their choices and to not do it prematurely, right? The economy is still doing very well from almost all measures, with the federal funds rate, the borrowing rate, being as high as it's been in a long time. So steady state, when everything is kind of great with the economy and there's not concern about inflation, I think it would be ideal to have that target federal funds rate lower, maybe 3%, 3.5% or so. But the concern or the risk of doing that, or lowering down to 3.5%, 3% too soon, is that, well, maybe you thought you had inflation tackled, you didn't, right? And so at that point, inflation spirals. Once inflation spirals, it becomes very difficult to really get it under control. So that is to say that we believe that they will start cutting their rates this year. It will not surprise me, as economic indicators continue to come out on a somewhat regular basis. And if inflation stays hot and everything else stays fine, it will not surprise me if that decision is postponed until 2025.
Oh, that's very interesting. Thank you for sharing that. So the next question has to do with the fact that the monies at the Jewish Community Foundation are in fact primarily philanthropic dollars. And individuals who have donor advised funds are using their funds to make contributions to various charities. And so the question has to do with, on the one hand, would it make sense to be more aggressive, because then people would have more dollars to give away? Or is it the wiser choice to be more moderate because we're in a long-term situation?
So yeah, it's an interesting question. Thanks for the question. Think about it this way: if you could lock your money in a black box and know you're not going to touch it for 100 years, and you don't have the ability to do so, investing in all stocks would probably be the way to go, right? That stocks have gone up more often and higher, of course, than bonds have. That's not the way that we're investing today. It's not the way that even though you're investing into perpetuity, you are accessing those funds. So I talked about that lack of correlation with bonds versus stocks, and how bonds have tended to be positive during periods where it was difficult to stocks have done poorly. Think back to 2008, where stock market was down, I think 38%, I believe, or over 40%. If you don't have bonds in the portfolio, your investments are down, let's call it 40%, whatever the stock market was down there. So being down 40%, well, your philanthropic goals, you might actually need that money to gift to people, to organizations, more than ever during periods of distress in the markets and the economy. Well, if you still want to give that same amount, but stocks are down 40%, your portfolio is down 40%, well, that same amount takes a much larger percentage of your portfolio than if things were a little bit smoother. So that's a long way of saying that we have bonds in the portfolio to make the ride a little bit smoother. We want to set some sort of realistic, we're not expecting to have the same return plus or minus 3% every single year, but we invest in bonds to smooth out the ride that helps for planned giving and expectations of what you might be able to gift going forward. Because if we were just to kind of ride the stock market bull and see where it takes us, you're going to have some periods where you have to spend, or you want to spend out of the portfolio during an unfortunate time.
Right. And I think many charitable organizations saw that in 2008, when the need tremendously increased, and donors were really called upon to up their game in terms of giving. So thank you for that. I don't see any more questions.
Actually, Linda, I see like one of the questions was a two-part question.
Oh, okay.
That asked about performance prior to Vanguard. So let me just say a few words about that. So the big advantage, really two big advantages of having a Vanguard or a Mercer helping us with investments is discipline. And so having this framework of the stock and bond allocation mixed in, and primarily using index funds has definitely helped our ability to manage the portfolio. not that we didn't have it before, but the biggest problem that we had before was, the cash flows of the funds, the cash flows, when people, end of the year, there's lots of money typically coming in when people give donations, sometimes during the year. For us as a committee to manage those funds was very complicated, and we'd have to take money out, sit in cash, so expecting money to come out all the time. It had a big impact on the performance to the extent of maybe as much as 1% a year. Since Vanguard's been taking care of that, and now Mercer has been taking care of that, that's almost an invisible process to us. So it's made a big difference to returns. So yes, we do have those returns prior to Vanguard, but we've seen a definite improvement relative to the benchmark since we've had this more disciplined process and better cash flow management in place.
Thank you, Harvick. And, I certainly was a tremendous advocate for bringing on a professional team to work with the investment committee. I think it's the best of all possible worlds to have that in tandem, or lay committee and professional management. So I don't see any more questions. I want to thank everyone for coming this evening. If you have any questions about your own particular fund, please feel free to reach out to Amy or I, and we would be happy to talk to you. And then again, thank you all for being with us this evening.
Thank you.
Thanks, everyone.